Hello everyone, it's me. Welcome back. Recently, one of my subscribers asked if I could make a video about Warren Buffett's margin of safety principle. The simple explanation is that Warren Buffett buys stocks when their market price is significantly below their intrinsic value. First, a low PE ratio, price to earnings ratio, or PE, is a valuation metric that compares a company's current share price to its earnings per share. If a company has a PE ratio of 15, for example, that means that investors are willing to pay $15 for every $1 of earnings that the company generates. I personally like to look at a company's debt-to-equity ratio, its earnings per share, and its dividend history. A high debt-to-equity ratio means that a company has taken on a lot of debt to finance its operations, which can be a red flag for investors. If you have any questions, feel free to leave them down in the comments section below. Also, please consider subscribing to my channel, and I will see you next time. On the other hand, a low debt-to-equity ratio indicates that a company has a healthy balance sheet and is less likely to go bankrupt. A company's earnings per share, or EPS, is also an important indicator of financial health. EPS is a way to see how much profit a company is making for each share of its stock outstanding. A growing EPS is generally seen as a positive sign, since it indicates that the company is becoming more profitable over time. Finally, a company's dividend history is also an important factor to consider. Dividend is a way for companies to return a portion of their profits back to shareholders. A strong dividend history indicates that the company is profitable and is committed to rewarding its shareholders, which is always a plus for an investor. Generally, a low PE ratio means that a company's stock is undervalued by the market, while a high PE ratio means that it's overvalued. He only invests in companies that he believes have a strong competitive advantage and a long record of profitable operations. If you want to emulate Warren Buffett's strategy, you should do the same thing. Don't be afraid to avoid a stock, even if its price is below its intrinsic value. If a stock is popular on Wall Street bets, for example, it probably does unqualify for the margin of safety principle because it is driven by market hype and short-term trends rather than long-term fundamentals. To find out the market average PE ratio, you can look at the S&P 500's current PE ratio. According to Google Finance, the current PE ratio of the S&P 500 is 22.83. So a good rule of thumb is to only consider buying a stock if its PE ratio is below 22.83. You can choose to use a different benchmark index, but I think that the S&P 500 is a good starting point. But if you ask any investor, including Warren Buffett, what is the exact price that makes a stock a good deal? It is calculated by dividing the current share price by the company's book value per share. Similar to the PE ratio, a low price-to-book ratio suggests that a company's stock is undervalued by the market, while a high price-to-book ratio suggests that it's overvalued. The industry average for the price-to-book ratio is usually between 1 and 2, so I would only consider buying a stock if its price-to-book ratio is below 1. You will never get a straight answer. Warren Buffett looks for 3 things when determining whether a company's stock is undervalued. Number 1, a low PE ratio. Number 2, a low price-to-book ratio. And 3, strong financials. Let's take a look at these, one by one. Second, a low price-to-book ratio. The price-to-book ratio is another valuation metric used to determine the value of a company as stock. Third, strong financials. What does this mean exactly? Well, there are several metrics that you can look at to determine if a company has strong financials. Finally, remember that Warren Buffett is a defensive investor. That's all I have for you today. Thank you so much for watching, and I hope this video was helpful.